If you rewind the clock to the late 1990s, you can almost feel the electricity in the air, an intangible hum buzzing through trading floors, Silicon Valley garages, and living rooms lit by the glow of bulky desktop monitors. It was the sound of a new frontier opening a digital promise, whispering that the old rules of economics no longer applied. The internet, once the quiet domain of academics and engineers, had burst into public consciousness, and with it came a belief so intoxicating that it rivaled the manias of tulips, railroads, and radio stocks before it. This was not just a technological revolution, it was a financial fever, and like all fevers, it blurred judgment before breaking bodies. The 1990s had been kind to America. Inflation was tame, unemployment, low productivity rising. The Cold War was over, globalization accelerating, and the Federal Reserve under Alan Greenspan was widely regarded as the master conductor of a great moderation. Markets seemed calmer, recessions, shorter crises, containable. Against this backdrop of confidence, the internet arrived not as a risky experiment, but as destiny. It promised infinite scalability, frictionless commerce, and a future where information moved at the speed of light. Investors did not merely see opportunity, they saw inevitability. And inevitability in finance is the most dangerous word of all. I often imagine walking through a trading floor in 1998, watching young analysts, some barely out of college, speak with absolute certainty about companies that had never earned a profit. Valuation models were discarded like outdated maps. Earnings no longer mattered. Eyeballs did. Cash flow was old thinking. Burn rate became a badge of ambition rather than a warning sign. A company did not need customers, it needed users. It did not need revenue, it needed growth. And above all, it needed a .com, at the end of its name, a digital talisman that seemed to conjure capital out of thin air. Venture capital poured into Silicon Valley at a pace that felt surreal. Startups were founded in weeks, funded in days, taken public in months. Office spaces filled with beanbags, foosball tables, and whiteboards scrawled with slogans about changing the world. Founders spoke not of businesses, but of movements. Journalists amplified the narrative, casting entrepreneurs as prophets of a new economy. Television shows celebrated day traders as folk heroes. Taxi drivers offered stock tips. Shoe-shine boys once again whispered market wisdom. History was repeating itself almost mockingly for those willing to notice. The stock market responded with breathtaking enthusiasm. The Nasdaq Composite, home to many internet and technology stocks, began a vertical ascent. Between 1995 and its peak in March 2000, it rose nearly 400%. IPOs doubled on their first day of trading. Companies with no profits and vague business plans commanded multi-billion-dollar valuations. Pets.com, Webvan eToys, names that would later become punchlines, were once celebrated as pioneers. And every successful IPO reinforced the belief that skepticism was obsolete. If prices rose, the logic went, then the market must be right. But beneath the euphoria lay a dangerous convergence of forces. Monetary conditions were loose. After the Asian financial crisis and the collapse of long-term capital management in 1998, the Federal Reserve had lowered interest rates to stabilize markets. Liquidity flooded the system. Capital, cheap and abundant, chased returns wherever stories were most compelling. At the same time, online trading platforms democratized speculation. Anyone with a modem and a credit card could trade stocks from home. The barrier between investor and gambler dissolved. Markets became faster, louder, more emotional. What made the dot-com bubble unique was not merely its scale, but its narrative power. Unlike previous manias centered on physical assets, land, railroads, factories, the internet was intangible. Its value lay in potential, not production. This allowed imagination to outrun arithmetic. Investors convinced themselves that network effects would guarantee monopoly profits, that first-mover advantage justified any price, that losses were investments in future dominance. It was not that people ignored risk, it was that they redefined it out of existence. Even Alan Greenspan, who had famously warned of irrational exuberance in 1996, hesitated to act. The Federal Reserve faced a dilemma: raise rates and risk, choking off genuine innovation, or stand aside and let markets sort themselves out. In an era intoxicated by productivity gains and technological optimism, restraint felt regressive. And so the bubble inflated further, nourished by policy caution and collective belief. But bubbles are sustained not by belief alone, but by the constant arrival of new buyers. By late 1999, cracks began to appear. Some high-profile internet firms missed earnings forecasts. Venture capital funding showed signs of strain. Insider selling increased. And yet prices kept rising because fear of missing out proved stronger than fear of loss. Investors who questioned valuations were mocked as dinosaurs, relics of an industrial age, unable to grasp the new digital reality. The market had declared a generational shift, and no one wanted to be left behind. The peak came quietly, almost anticlimactically. On March 10, 2000, the Nasdaq closed at its all-time high. There was no dramatic announcement, no single catalyst, just exhaustion. In the days that followed, selling accelerated. Confidence wavered. A few stocks fell sharply, triggering margin calls. Others followed. Liquidity dried up. The stories that had fueled the ascent suddenly sounded hollow. When investors tried to exit en masse, they discovered there was no floor beneath their expectations. As prices collapsed, the illusion shattered. Companies burned through cash at alarming rates. Advertising dried up. IPO windows slammed shut. Layoffs spread across Silicon Valley like a cold wind. Office spaces emptied. The beanbags remained, but the optimism vanished. By late 2002, the Nasdaq had fallen nearly 80% from its peak. Trillions of dollars in market value evaporated. Fortunes were erased. Careers ended. And the world was forced to confront a painful truth. The internet had changed everything, but it had not repealed the laws of finance. Standing amid the wreckage, it became clear that the dot-com bubble was not a failure of technology, but a failure of imagination, disciplined by reality. The internet would indeed reshape commerce, communication, and culture, but not at the pace, nor with the profitability that markets had priced in. Innovation had been real. Valuations had been fantasy. And as investors surveyed the damage, they began to ask the same question that echoes after every crash. How had so many intelligent people believed something so fragile could support something so vast? A question whose answer would only fully emerge in the aftermath, as regulators, entrepreneurs, and investors struggled to make sense of the ruins left behind by a bubble built on bandwidth belief and borrowed time, a struggle that would soon reveal the deeper lessons hidden beneath the wreckage. Lessons not about technology itself, but about human behavior, capital, and the eternal seduction of stories over substance. For when the dot-com bubble burst, the world did not abandon the internet. It abandoned the illusion that growth alone was a substitute for value. And in that distinction lies the true meaning of the crash. The immediate aftermath was brutal. Silicon Valley, once vibrating with confidence, fell into an uneasy silence. Startups that had burned millions chasing market share without a path to profit collapsed almost overnight. Venture capital firms, once reckless in abundance, turned cold and selective. Office leases were abandoned. Servers were unplugged. Talented engineers found themselves unemployed, wandering a valley littered with the remnants of ambition. It felt less like a correction and more like a reckoning, a forced return to economic gravity after years spent floating in the thin air of speculation. But the collapse did not stop at technology firms. Pension funds, mutual funds, and individual investors absorbed staggering losses. Retirement plans built on perpetual market gains suddenly looked fragile. Trust in Wall Street, already bruised by earlier scandals, weakened further. The crash exposed how deeply the bubble had penetrated mainstream finance. This was not a niche collapse, it was a systemic disappointment. And as markets reeled, the Federal Reserve once again stepped into the spotlight, cutting interest rates aggressively to prevent a broader economic contraction. Liquidity returned, confidence stabilized. The recession that followed was real, but mercifully short. Yet the true consequences of the dot-com bubble unfolded more slowly in how markets, entrepreneurs, and policymakers internalized its lessons. Investors rediscovered fundamentals. Profitability mattered again. Cash flow returned to center stage. Business models were scrutinized rather than celebrated. The phrase "new economy" faded, replaced by a more sober understanding. Technology enhances economics, but it does not erase it. This recalibration reshaped venture capital for a generation. Risk did not disappear, but it became more deliberate. Ironically, many of the technologies dismissed during the crash would later become the backbone of the modern economy. Amazon survived by focusing relentlessly on logistics and long-term scale. Google emerged with a clear revenue model tied to advertising. Apple, nearly written off in the late 1990s, reinvented itself by marrying technology with consumer design and profitability. The survivors of the dot-com era did not win because they were first. They won because they endured. They built real businesses beneath digital narratives. The bubble burst did not kill innovation. It purified it, but there was a subtler, more dangerous legacy. The policy response to the crash, low interest rates, ample liquidity, faith in central bank intervention, set a precedent. Markets learned that when asset prices fell sharply, monetary authorities would respond forcefully. This belief, sometimes called the Greenspan, altered risk perception. Investors began to assume downside protection while chasing upside aggressively. Capital flowed once more into speculative assets, not internet startups this time, but housing structured finance and leverage. The dot-com bubble had burst, but the psychology that fueled it merely changed costume. And so the dot-com crash became a bridge between eras. It marked the end of naive digital optimism and the beginning of a more complex financial age, one where technology and finance intertwined more deeply than ever before. Online trading platforms evolved. Algorithms replaced traders. Data moved markets at unprecedented speed. Information became abundant, but wisdom remained scarce. The seeds of the 2008 financial crisis were not planted in Silicon Valley, but the lessons of dot-com about leverage, belief, and systemic risk went partially unheeded. When I reflect on the dot-com bubble, I do not see it as a failure of innovation. I see it as a failure of patience. The internet was real. Its impact was inevitable. But markets demanded immediate rewards from a transformation that required time. Capital, impatient by nature, rushed ahead of reality. And when reality failed to keep pace, prices collapsed to meet it. This pattern, overestimating short-term impact while underestimating long-term change, repeats endlessly in financial history. Railroads, electricity, radio, the internet, artificial intelligence. The technology changes, the behavior does not. And this is the enduring lesson of the dot-com era. Markets are not engines of truth, they are amplifiers of belief. When belief detaches from fundamentals, prices soar. When belief shatters, prices fall faster than reason can explain. The challenge for investors is not to predict innovation, but to distinguish between transformation and fantasy between timing and truth. Today, when we speak casually of bubbles of hype, cycles of speculative frenzies, we are speaking the language forged in the late 1990s. The dot-com crash taught a generation of investors humility. It taught entrepreneurs discipline. And it taught policymakers that technology-driven optimism can be as destabilizing as fear. The internet did change the world, but only after the market was forced to relearn the oldest rule in finance: value must eventually justify price. If this story of ambition, illusion, and endurance resonated with you, if it changed how you see innovation or speculation, share what struck you most. And if you want to keep exploring how financial history repeats itself under new disguises, follow the channel and stay with this journey, because the next bubble is always being built from the lessons we think we've already learned.